if you're flagged. They might say you're all current, you paid them all in full. We're just investigating this. And it's giving us this error code. And they're like, we can't even give you any more details. We just can't approve you and you're not going to be approved. And it's like one of the worst things I've seen or experienced doing this because very frustrating. So I had 3 deals die from that. You've just bought a business with no money. That gets a lot of attention. Now every lender is going to have to decide to do it. I'm only doing those in 2 very select situations, but otherwise we're still kind of going with putting 5%. You put in 5 and then the seller can hold 5. And at least now it doesn't have to be on full standby for the life of the loan. Like if you were doing this previous years to get the seller to contribute part of your equity injection, they basically had to park their seller note at 5% away for 10 years, essentially. A lot of buyers want that anyway to give the business a little time to stabilize. Then I'll start paying you. And now that's going to count towards your injection. No, thank you for letting me be with you today. I've been in SBA lending for my entire career, actually. I fell into it when I was 21, believe it or not, and I fell in love with it. And I've been doing it ever since. And currently, I'm managing business development officer at Fundex. So I joined here about 3 years ago. It was a startup. It's my second time being part of a startup SBA shop. In our industry, it's banking, so it's kind of old school. So I like kind of being at the forefront where you can kind of build like that new best version of what this is. And so now we're in a place where we're pretty stable. We're just focused on the acquisition space. And I built a nice team around me to help facilitate SBA acquisition loans in the most efficient way possible. And it's just something I like doing, and we're going to keep it going.
That's awesome. How many or how much volume does the Fondex do a year now?
So we just looked actually. We're currently ranked number 24 in the country, out of a little over 1,000, and that volume. The last couple of years, we've been doing about 150 million. Which in the SBA space kind of gets you in the top 40, and we're a little bit ahead of that this year. And this year it starts in October because it's a government program, so it's fiscal year. But so we're kind of smaller. We're a little more nimble. I like being in this kind of range, right? Because I have direct access to everyone in the company. And me and personally, the deals I originate and with my deal team around me, we do about 50 million a year, under the Fundex umbrella. In fact, in 2022, we were 50% of Fundex's volume, which was cool. So it's been great because they've just really supported me and, my small business, buyer clients in helping us grow.
Nice. So how did the change so first of all, before that, let's, how do SBA lenders differentiate since they're selling the same product, if you will, this government program? How do they differentiate among themselves, and how can like a buyer figure out who's who and how to pick a good SBA lender?
Well, that's a great question. And, I was talking to a buyer. I got introduced to a buyer this weekend, and I responded. So that's my first differentiator. But he was like, hey, he comes from some wealth management or private banking type of deal. So a lot of stuff in banking and in lending is commodity. It's like, oh, I'm buying an office building with a 7 cap. Let me get all the term sheets and let's compare and pick one. It's like with SBA, it's so different. It's all about execution because the process is unlike anything else that I've ever seen. And so he was like, hey, I'm talking to you. I'm talking to Chase. I'm talking to this bank. I'm talking to that bank. And I'm trying to find the best deal. And that's a lot of people because that's what I would do if I didn't know. But then I said, here's a couple questions you should ask, right? In the SBA space, banks specialize in different things under the SBA umbrella. So the number one SBA lender currently, which is New Tech, they don't do many acquisitions, right? So you can say they're the number one, but they're not doing acquisitions. They're doing debt refinance, equipment purchase, commercial real estate. The number one SBA lender in the country by units is Huntington National Bank. Well, they're like a significant portion of their volume comes from startup franchises. They're dialed in with all the franchises. So how much of your volume that you do, your production, comes from acquisitions? From us, it's 90%. So obviously, we're a specialist in the space. And then that's one. And then, when you finally find a deal, and if you've been searching for a while, closing that deal becomes so valuable. And you have to work with folks that are set up to convert to convert approvals and closings, because it's you don't have room to kind of play around and waste 6 weeks talking to a bank that doesn't really know how to do an acquisition deal. And so we pride ourselves on our ability to execute. Specifically, me and my deal team around us, like we just finished another year where out of all the term sheets I issued, I converted 100% of them to approvals. So obviously it doesn't get higher than that.
Yeah.
So I said, who are you? So one of the banks they named, they said they're very aggressive. Okay. So I looked them up because all the data is public. And I said, okay, well, they did 18 million last year. I did 50 by myself. So, I don't know about that much,
Yeah. The
So
challenge, the point around closing and executing is very valuable, because a lot of times you don't know until you're, in the middle of the transaction for you to know the execution piece. And if you don't understand lending, the loan officer will tell you all kinds of stories. You're not going to know, again, until you're in the middle of the transaction. So how do you, there's definitely an art to closing a loan, if you will, and how to tell the story and how to, explain things. So how do you kind of navigate that or explain that to a buyer that just he has no idea?
I'm still figuring that out because, I listen to a lot of podcasts and stuff and buyers. And when they talk about, I really try to understand the borrower. And if you're a business buyer, I've done so much work to try to understand that person, because I've talked to so many who are at literally, it's one of the first things they tell you to do is talk to some lenders, build some relationships. So I'm talking to people right as they're like, okay, I think I'm about to quit my career here working at Procter and Gamble to go buy a business that does, some random thing. And so I'm talking to them right at the beginning stage. And so you're kind of in that, you're understanding that mindset. And when a lot of them talk about putting the deal together, you might have investors, you might need to find the deal, and you got to get debt. And that's it. We think of it like, get the debt. Well, there's so much, I live in the debt. So I know everything behind that sentence. I got to get the debt. And so you just want to work with somebody that knows what they're doing, right? You don't want to have to worry about it. So most people think like, yeah, work with a specialist. And if you at least do that and just ask some simple questions, you're a well-known commodity in the acquisition space. I'm going to work with you because I know how important it is to work with specialists. Like if I need to get a knee replacement, I'm not going to go to my primary care physician. So people mostly understand that. And maybe it's not even, sometimes I really like to educate and go deep into the weeds on exactly why, but I don't know if that's even what I should be doing, to be quite frank, because I, I don't need to know everything. I just need to work with the right people.
Yeah, no, that makes sense. And so what are the latest, updates to the SBA operating, instructions or whatever, the SOPs? Yeah, and I know that recently there was like a little bit more flexibility for banks to do their own underwriting as opposed to follow SBA underwriters. So can you tell us a little bit about all the changes and all about that?
Yeah, I think that's my simplified. And there's a video I put out on my YouTube. It's like my last video. So if you go to SBA Ray, I break down because I break down all the updates because I basically there's like 7 takeaways I put in the video because there was so much back and forth last year. Like the SBA program, they put out some new rules in May that had us like, whoa. Then they put out more new rules, and a couple weeks later, and then they changed it like 3 times. So it's like, if you're not following it like every day, like it is impossible to keep track of.
Yeah.
I'll just go over two big takeaways that are going to impact all of you guys. One is the equity injection and seller financing component. And so essentially, when you're buying a business, the SBA is going to require you to put a 10% equity injection. Now, first misconception is it's not 10% of the purchase price, it's 10% of the total project. So we talk about the total project, it's three things: the purchase price, the closing costs, and the working capital. Working capital is a whole nother, probably need a whole nother hour on that. But those three things add up to total project cost. Let's say that adds up to 5 million. That means the equity injection is what? 10% of 5 million, 500,000. So now the seller can provide that entire thing theoretically. That's the big change that the SBA made. They said we can let the sellers contribute. Used to be limited to half of that. Now it can be the whole thing. So it used to be 5%. Now theoretically it could be 10% if a bank's willing to do it. I can let you know what I'm willing to do and what I'm not, but this is going to vary bank by bank.
Yes.
Essentially, if a seller holds a note for 10%, puts it on standby for 2 years.
Yeah.
So no payments for 2 years, we'll consider it equity. Now, the only problem with that is if you buy a business with 90% debt and 10% seller note, even with pausing the payments for 2 years, you've just bought a business with no money, right? No money down, which is not, that gets a lot of attention. Now every lender is going to have to decide to do it. I'm only doing those in two very select situations. But otherwise we're still kind of going with putting 5%, right? You put in 5 and then the seller can hold 5. And at least now it doesn't have to be on full standby for the life of the loan. Like if you were doing this previous years to get the seller to contribute part of your equity injection, they basically had to park their seller note at 5% away for 10 years, essentially. Yeah. So they're not seeing that money now. Very reasonable. 2 years, no pause payments. A lot of buyers want that anyway to give the business a little time to stabilize. Then I'll start paying you. And now that's going to count towards your injection. So it's really opened the door, one, to getting a lot more sellers are amenable to those structures. And two, if you're doing a second acquisition or you're a manager of a business buying a business, which probably, I don't know if anyone here is like that, but those are some scenarios where you can actually leverage even beyond that for us, where we're going to go a little bit beyond that 5% cash in, go down basically.
So let me go back for a second. So on a line of credit, or not line of credit, on the working capital, if there's a line of credit for working capital, is that becomes part of the cost of the project, or no, just when there's actually an injection of cash?
No, it wouldn't be part of the total project cost.
Got it. Okay. And then the other question is the 2-year standby. I've heard 3 years, I've heard 2 years, and everyone is saying different things. And this is like within the last 2 weeks. So it is 2 years. You don't need 3.
It's 2 years. You heard it here first. That's fine.
Okay. And then the 10% being standby for 2 years can be used you said there are 2 conditions where you would allow that for your bank, because I know every bank is different. And I've also heard as low as 2.5%. So there's like another scenario.
This is where it gets a little tricky, right? Because every bank's going to do different stuff. So
what are the two conditions that you said that it would?
So here's how we're viewing it.
Yeah.
Regular person quit their job, got laid off from tech, whatever, they want to buy a business, 5% cash. Okay. Right? Reasonable.
Yeah.
Now, if you know the industry inside and out,
yeah,
that's going to mitigate a lot of risk. So we're going to go down to 2.5% on those.
Okay.
Now, if you're running the company already, you're mitigating a lot of.
You're inside that same entity.
You're already in the business. You want to buy the business.
Yeah.
You've got some sweat equity, and so I can do that without any cash.
Okay.
Now, if you own a business currently, and let's say it's I don't know, I can't think of a business.
Landscaping business. Yeah.
Okay. And now you want to buy a property management company.
Yeah.
Okay. So those are 2 different industries, but you can make the case they're related.
Yeah.
So, this is the landscaping business. This business, I look at the balance sheet, there's a little equity in there.
Yeah.
You want to buy this business, property management. Now I'm going to loop this business in as a guarantor or co-borrower or something. But like, if you wanted to go and buy that business, I could get you in there with no cash down. We can do that. You can buy the whole ecosystem, around you, and we can get all leverage up, with SBA debt. And essentially what we're doing is leveraging equity that you already built up to go and make future acquisitions and preserve your cash. Right. So
Do
that,
they have to be? Do they have to be in the same state? Let's say a landscaping business in Connecticut. They want to buy a business in Florida. The guy lives in both states half the time. Will that same business, same
yeah,
codes and anything?
it, there's nothing stopping you. The only thing I'll say on that is, like, in general, like on businesses that are physical businesses, you want to be in the business and be near the business. So like, potentially if it's a business where maybe there's seasonality where we're
Correct.
really busy over here
Correct.
and then we go here and you go back and forth, there's
Yeah.
probably a way to make that work as long as your plan is to be kind of committed to the business and the deal. Like, we just don't want to do stuff where, and this is whether it's for this or even buying your first business. Like, if you're, buying a business out of state and you don't plan on being there, it's, that's just a tough sell unless it's like a remote type of business, like e-commerce or SaaS or something like that.
Got it. Yeah, it makes sense. And then what kind of debt service to be comfortable? Where are we, like 1.5, or you have to be to go to the high, the 2.5 route, or is the debt service requirement goes up or stays the same?
In general, we're looking at anywhere between 1.25 to 1.5. The bigger question is, where are we looking for that?
Okay.
Because we're looking at 2020 tax return, 2021 tax return, 2022 tax return, and 2023 year-to-date financial statements. So, our focus is on the last tax return and then the interim financial statement. So right now, that's 22 and 23.
Yeah.
Now, a lot of sellers, if they're trending up a little bit, they're for sure trying to sell off 23 numbers, but that's
Right.
not the tax return. So if it doesn't work in 22, the tax return, then they're going to have to file that 23 return ASAP and give us like a Q1, P&L or something like that for 24, when that time comes. And that might delay that type of sale, but we are seeing a lot of that right now.
Got it. Are you seeing the numbers in 23 to be higher?
On the ones that are selling,
Yeah.
yes, because the sellers don't want to sell when they're down.
Got it. Got it. Okay. Yeah, I've seen it both ways. Okay. And so how about the underwriting piece? Like the flexibility around underwriting. Where do have there been any changes or not much?
Well, the big piece that happened was the partial change of ownerships are now allowed, right? So for years, when you bought a business with an SBA loan, you were buying 100% of the business and they wanted the seller out as fast as possible. The seller could stay on, and this is today, if you're buying 100% of a business, the seller can stay on as a consultant for up to 12 months. So they can't remain an employee. They can't remain, running the business. They're just there to transition it to the next operator. So what the SBA did last year was open the door to a partial change of ownership, where this is in private equity land known as, sellers rolling equity. However, it has to be done as a stock purchase where the buyer is buying a percentage of the stock of the seller's existing business. And you're seeing it so that the seller drops somewhere between 1 to 19%. So this is used in 2 or 3 main scenarios right now. One is licensing. So if you're buying HVAC or construction or something where there's that trade license and you as a buyer don't have that, what we've been having to do, because we don't want the seller has to remain, again, be out of the business, consult it for up to 12 months. So we can't rely on their licensing. But now under the partial change, the rules are different. So I did a deal in southeastern US, construction company. Buyers could not get licensed by the time of closing. Sellers retained 1%. And now all of a sudden they can remain an employee indefinitely and they can license the business for you. Now, before that was in the cards, we were going to have to go get an employee to, take the test and get an employment agreement, and you got to tell the employee about the sale, and it's all this whole thing. So that's a potential solution. The other way I'm seeing it is where you can and for negotiations, you can have the seller retain 19%, and you as a young, energetic operator can come in, your plans to grow it, sell it 5, 10, 15 years later, whatever, seller's getting a second bite at the apple. So, that's interesting too. And we're seeing more of that now. So that's opened the door to some cool creative structures. There's also, of course, some other takes on that, like the fact that the seller's remaining in the business, and is that confusing to the employees, and is a partnership with a seller a good idea? And that's stuff that's yet to be seen.
Yeah.
But in general, we kind of like these.
And they're all new. So because the rule is new, have there been a lot of deals done that way? Have you seen a lot of them go through?
We've closed some, we've approved many, and I mean, it probably on 25% or less, maybe 15 to 25% of my deals I'm seeing now that are structured like that. But you're seeing it more and more, but it's new. So,
Okay.
I mean, it's only been, the SBA really only cleared it up a couple months ago, because there was like a few months where you were allowed to do it, but it was confusing. And then the SBA finally cleared it up sometime around Halloween, I believe.
Yeah.
And so you've only had really about 3 months of this like full steam ahead.
So I have a deal now where it's an 80/20. So one owner owns 80, the founder owns 80%, and then he brought in someone that's essentially a GM at 20%. So if you buy the founder out, do you have to bring the GM down to 19% so they don't have any PG, or you can keep them in there at 20 as is? And
Good question. Anyone who is 20% or more personally guarantees.
okay, all right. So we have to come out and say it's 19.99.
I would probably stick to 19. You don't want to see 19.99 because the banks still have discretion, and
Got it.
you might want to round that up to 20. I wouldn't want to chance that. 19, you're probably safe. Some people even do 18 because they don't even want it to be that close. But
Close.
19 is, for me, 19 is fine.
Okay.
And it's interesting. They actually removed a regulation that would have prohibited that. That was part of the confusion. Like, there was a 6-month look back rule, and essentially the rule used to be anyone who's owned 20% or more within the last 6 months, personally guaranteed.
Oh.
Even that deal would have been kind of
Oh.
tough to do until like Halloween timeframe, or I think it was November 15th. But now you're fine to do that. But just know, again, like, every bank's going to do stuff different, and many banks might want that GM. I just had a large, unnamed, very large bank that you probably all know call me with a deal because they wanted the person qualifying the license to guarantee the loan, right? The SBA doesn't require that, but certainly every bank's going to do different things. So we tend to be more flexible, at Fundex. We are a non-bank lender, so non-banks typically, we're not regulated by FDIC. We're not as conservative as banks. We don't make money unless we close loans, right? So we have to close loans. It's kind of a cool situation where like all our interests are aligned, because like the only way we exist is by closing loans. So we got to close loans, and you got to sometimes get a little creative, make some business decisions, and close some loans. And, you want to be prudent. But you also have to be open to looking at things from different perspectives and trying to figure out creative solutions to get deals done. And that's really that's the whole value proposition that we're bringing to the table.
Got it. So tell me, what do you think about working capital?
Okay. I think it's important. It's like the biggest reason a deal is not going to work in the first 12 months is because we screwed up working capital.
Yeah.
You have to you start with just understanding the business's cash cycle, like, really well. I was on a call with a seller. I don't always get on calls with the seller, but like this one was one of these situations where you had hopefully no one's on the call who's involved in this, but it was a commercial real estate broker selling a business. Anyone
No.
you know? Oh yeah, exactly.
Yeah.
So, you know, they haven't sold a lot of businesses, if not maybe any ever
Yeah.
sold a business. But so they're like, first of all, they're not sure. They didn't think that it was possible for the buyer to buy this $3 million business because there's no collateral. Like, we don't believe it. So I got on the phone and just had a conversation to like, yeah, here's and pointed to 100 other ones I did just like it, in recent years. And so they got comfortable. But one of the things that the seller um said on the call was, all right, so the buyer negotiated this deal, and it's funny because, like, how sometimes the brokers want to keep the communication really controlled. So we had to have this call to make sure that the sellers got comfortable with the fact that, yeah, you can get an SBO and buy a business like this. So it gave the buyer an opportunity to have another call with the seller. And it's funny, I'm just asking some basic questions, and the buyer is like, I'm talking to the seller and the broker, but the buyer's there. And the buyer's like, wait, hold on. I thought we said, it's like new stuff was coming out. Like, wait, I thought you said there wasn't any customers that had 10%. Because I had asked a question and they're like,
Yeah.
yeah, we have a customer that does a million of revenue for us. And that's like 15%. So the
Yeah.
buyer's like, wait a minute. So then I'm asking about the cash cycle. And I said, how's it work? And they're like, well, our customers don't like to give deposits, right? This is a 25-year-old business, founder, classic example, handshake deals. We don't collect upfront deposits. I said, okay. So do you get terms from your vendors? No. So they have to pay for the inventory in cash, collect no deposits. And then I said, what are the terms you give for your customers? And they said, well, we try to do 30 to 60. Some get net 30, some get net 60. And he's kind of basically saying some roll into 90. So I'm saying, okay, well, the contract is written so that you're not, no AR, no cash is being transferred on a $3 million deal. So buyers having to bring in the working capital. And I'm looking at that. I was like, their overhead's a $500,000 a month. I'm thinking we're going to need at least 2 months. So that's $1 million of working capital. So we kind of just high level put that together. And then we said, all right, so this $3 million deal is actually a $4 million deal. And you're paying like a 5x multiple now, essentially. So that deal now has to be restructured. So we're just kind of trying to understand how much is needed, how much are you getting from the seller, fill in the gap with the SBA debt, and making sure the deal still works.
Yeah. Yeah. And in that case, or cases like that, have you seen that sellers adjusted to that, or yeah,
No, they don't. They don't understand it.
yeah,
So the buyer knows that, and the buyer's like, I want the business, and he's just like, he knows he's not going to get a deal where the seller just leaves net working capital in. He just knows it. So he's like, maybe he can get the seller to um put in like 250,000. Maybe he only needs 500,000 and he's going to try to stretch it, and then I'll give him 250 and we'll try. But he also is like, the value, we got to bring down the valuation by 500,000. So he knows it's not going to be easy. And most sellers you're met with a lot of resistance because you got a number, you want your number. The broker has not done their job to educate the seller on this aspect. And that's a $3 million deal. And you rarely see it on a $2 million deal or less. You rarely see them leaving any working capital. But even as we get into the $3, $4, $5 million deals, still hard. And it's always a point of contention.
yeah. And I mean, we had a friend of ours who asked for cash, and the guy left $250K in the bank.
We've seen that, and those
Yeah,
I've seen a lot of them. I have deals like that too. Like,
yeah,
those are the deals actually getting done, right? Because
yeah,
they're, especially when you have those longer cash cycles. There's a construction company I'm doing right now. It's a $5 million deal, and they're leaving in 200,000 cash, and I got to give them another 300,000. Now they bill weekly, so they got a much better cash cycle.
yeah,
But that deal looks good. We had the other one I said where they left a 1%, or the 1% seller kept 1%. they actually left 200,000 in that deal too. So you do see, I've seen, especially in construction or where there's like where just you're burning cash a little bit more. Like, yeah, I am seeing, and it's usually for whatever reason like 200,000 is like the number.
Yeah. So in terms of like networking capital, so as a lender, do you rely on the due diligence, the quality of earning report to get like a cash flow analysis, or you just try to do your best and try to guesstimate what that number is? How do you come to the number of how do you peg that working capital number?
I don't, for whatever reason, for better or worse, and I love QVs, but I just don't do a lot of deals that have QVs. So, uh, so that's
People
not,
are living dangerously, huh?
uh, yes. There is, it's, I don't know, I can't explain it, but, the, my underwriters do an analysis. So I do that high level, kind of like I just told you up front,
Yeah,
to make sure we get in the right ballpark. And my underwriters do a more in-depth cash flow analysis, um, as part of their underwriting as well.
got it. Got it. Okay. And in terms of like the whole businesses like this, like you were talking about 50% when they take deposits up front, when there's inventory in place, when there's, um, do you go into the nuances of all those, what's deposit and what's not? Because, if you don't have a QOV, how the hell are you going to know what's coded as revenue and what's should be a deposit?
Yes, so we see a lot, we do a lot of in the construction business, to be honest
Yeah.
with you.
Yeah.
Mostly because a lot of lenders don't like it.
Yeah.
And, we will look at the deposits. The deposits are usually on the balance sheet, and the contract usually will have some verbiage on the deposits and how they're being split up at closing. So we just, all we do is we take, tax returns, we take financial statements, we take our discussions, we take the documents we have, we underwrite. QV and buyer due diligence, to be quite honest, it is and should be going further than us.
Yeah.
So
Okay. So, okay. Um, so in terms of, what are the things that you've seen that kill deals? So can you list a few of them
um
outside of
yeah.
working capital?
Well, I'll say this. I talk to a lot of people that are pre LOI. So I don't want to get into what kills deals before LOI, but
Got
after
it.
LOI,
Yeah, yeah.
um, for LOI, there's not a deal to kill, right?
Yeah.
So LOI on, I don't see a ton of fallout. So it's a lot of one-off things. If I had to guess, I can name like a few one-offs, but you could have a landlord blow up your deal. Um, you can have the SBA. I actually had 3 deals die last year because of the new SBA approval process. So that is essentially affecting like 1% of deals, but if it's your deal, it really sucks. Essentially, the SBA is actually checking now every deal before the approvals issue. It used to be automatic. Now it's still pretty quick, but like they're flagging certain deals where, if you today own a company that got a PPP loan or an EIDL loan, totally unrelated, but you owned a company, maybe you sold it, whatever. Um, they're just flagging some of those and investigating some of those. And there's nothing you can do if you're flagged, right? They might say you're all current, you paid them all in full. We're just investigating this, and it's giving us this error code. And they're like, we can't even give you any more details. We just can't approve you, and you're not going to be approved. And it's like one of the worst things I've seen or experienced doing this. Because very frustrating. So I had 3 deals die from that. Um,
So this is the buyer had a PPP loan, a couple of years ago, or EADL loan it may have paid it or been forgiven, but in the system it flags it.
Yeah, and if it's a stock purchase, it could be the seller's entity that's screwed
Yeah.
up too. Um, we are being a lot more proactive when it comes to pulling the SBA approval numbers so that we can figure out potentially if there's issues earlier. But we learned that one the hard way. Because that was literally overnight. Like if I had pulled the SBA approval the day before,
Yeah.
you would have been fine because it's been automatic for as long as I remember. And then all of a sudden we're pulling it, and the SBA is kind of running some checks with their different systems, the state website, the SBA, the Treasury, and just looking for flags. And that's what we call now the kiss of death. Is that particular one flag, because there's really no escaping it. I think like 99% of them are not being cleared. I just made that stat up, but
Yeah.
about that's what it feels like. And so, not a
You
huge,
just
I mean,
get stuck.
nothing you can do. It's just a landmine. It's just like, hey, we're out here in the battlefield, and there's a landmine that's worse than all the other landmines because there's nothing you can do about it. But it's one little landmine in a giant field, so hopefully it doesn't impact you. But the landlord stuff, though, is real. There's two documents that landlords have to sign: a lease and a landlord consent. When you're buying a business, the only incentive the landlord has is we're going to keep a tenant in there, but they just doesn't seem like that's enough for them these days. So like they're like, oh, I don't want to renew the lease, or I don't want to sign this landlord consent form.
Yeah.
Ideally, the lease is 10 years, like the SBA loan. Now, if it's not a business that like an HVAC business doesn't really need a location, or it doesn't matter where the location is, we can get around it, but you're still going to need a lease, and maybe we can get away with an annual, but like the standard condition is a 10-year lease. Now we're going to have flexibility there. Not every bank is, but just know that lease is a big part as well as the landlord consent form. Because now you're getting the landlord to agree to a couple things that are super reasonable, but sometimes you just 1 out of every 10 landlords just says no, right?
Yeah.
The purchase agreement is definitely where the rubber meets the road. I mean, it's a few weeks of back and forth. We've been coming together on like 99% of them from my standpoint. In my space of like $1 to $5 million transactions, which is my sweet spot, I'm seeing a lot less deal fallout than like my friends that are doing like the $5 to $10 million deals. They're seeing a lot more deal fallout, but it's a different type of buyer. Like they work with a lot of um, search funder, Q of E, breaking up deals, stuff like that. Like I said, I'm kind of working more with um the more traditional buyers, and Q of E's are on 10%, only 10% of my deals, and maybe some of those should be blown up a little bit more, but they're not doing the Q of E to figure it out. So I'm seeing a very high conversion rate.
What's common in the purchase agreement that creates issues? What are some of the things in the purchase agreement that may come up that create problems?
That's a good question. We talked about working capital. I see so many LOIs where it's like seller shall leave adequate working capital in the business. Okay, well, you're kicking the can down the road on that one.
Yeah.
That certainly is one of those pieces. Non-compete, you don't really see come up too much, but if you do get pushed back, it's a big red flag. So like non-compete, we go for 5 years, and I don't know the mileage. It depends on business. It could be 20 miles, it could be 50 miles. But I've gotten pushback, but it's at the end of the day, like, the buyer's like, I need a 5 year, and the seller's like, no, I'll give you 3, and they're like, well, are you gonna are you gonna compete with me after 3? And they're like, no, we don't want to do that. Then why won't you sign the 5? Like, so that's an easier one to resolve. It hasn't blown up any deals. The splitting up the deposits is something that is not a deal killer, but it takes a lot of nuance and a lot of discussions on the work that's all in process and how much is complete and what percentage done, and what percentage of the deposit should I get,
Yeah.
and splitting that out. And what else? What else, Jay? Am I missing anything?
So essentially, when on the deposits, you're talking about if they have if there are receivables that they're going to take, then which deposit correspond to which receivable and what needs to be collected that may be billed within the transaction.
Yeah, exactly.
Interesting.
Um, yeah, yeah, like if you're working on 10 projects the day of closing
Yeah.
and you've collected 50% deposits up front on all those jobs, but you know, this job's 10% done, then the seller uh uh or if this job's 10% done, you know, that is going to this is probably a bad example. This sell and by the way, last time I did one of these, my mind was like this as well. I'm like through it.
So what was the agreement? The agreement was the seller will collect anything that's 50 more than 50% or more than 80% done, or what was the agreement?
I have seen it work has been essentially that um based on percentage of completion. So if a job's 70% done, then 70% of the revenue from that job should go to the seller.
Interesting. Okay. Interesting. Yes. I don't know if it's ideal, but what have you seen? To me, the way I think of it, you just got to pay for those receivables and call it a day because you don't want the seller to be going out collecting receivables from your clients. If if he doesn't care and he gets mean, then you lose the client or the relationship, then it's a problem.
Yeah, and logistically, I don't think it's a matter. I think the business will still collect that type of situation.
Okay.
That's going to be viewed a little bit differently. Like a receivable in those types of businesses, I believe is more like we finished a job and we've invoiced, and now that's a receivable.
Got it.
Um, but the deposits, that's a little, but this is like really specific to construction businesses.
Yeah.
Um, Inventory is another thing that's like tricky. Number of SKUs and stuff like that. Inventory counts.
Yeah.
It's not anything that's blowing up deals or anything like that, but like,
Do you usually have someone? Do you send someone to validate the count, or you just assume like you just take whatever they give you?
it's worked out between buyer and seller.
Okay.
Whether the buyer is performing the inventory count with the seller in the warehouse or hiring a third party, we let the buyer and seller deal with it,
Yeah.
and we get the inventory count at the end.
Got it.
Um, but you know, you got to kind of structure those in a way that it's because it's coming so soon before closing. You've got to structure it in a way where you're not gonna be in a position where we have to change the loan amount and all this, the loan kind of
Makes sense.
structure right before closing. So usually there's a seller note there that you can, move up or down, and hopefully it's a small amount, so it's not gonna be, disruptive to the closing.
How about equipment?
Equipment's a big one. I mean, equipment is not. It's again, this is one where when I think of equipment, I think of I bought the business. This equipment has deferred maintenance that I missed, or I knew about, but it's just like I just maybe worse than I thought. Sellers don't want to upkeep, and spend that money leading up to selling their business to maximize their SDE, and so you're coming in and you're realizing I've got to fix this, I've got to fix that, and that's cash outflows. In year one you might not expect, and then also like fleets of vehicles that are just beat up, and I always hear like, oh well, they just upkeep it really well, so these things can run forever, is like kind of
Yeah.
like the sentence you get, but they don't. And so then you have a lot of capex on the vehicles. So like you do want to do, if there's a fleet, you definitely want to do due diligence on the vehicles. Um, and you, not everyone does. A lot of people do miss that, believe it or not.
So who we've seen like that does it right? So they hire like a third party that does like looks at the vehicles, the fleet, they value it. They give you a valuation, or what's the best way to do it?
So one, we can get an appraisal done. So a third party can come out and do that. some buyers elect to just request the maintenance logs and paperwork around the vehicles and then look at it themselves. It just depends on, how big the fleet is and how important, you know, relative to the size of the business. Like I looked at a deal the other day that had 21 vehicles and it was a $600,000 deal or an $800,000 deal. I don't even know if it's a deal, but it basically high level, somebody brought that to me and I said, that's a lot of trucks to basically make not that much money.
Yeah,
That's you're maintaining 21. It was large vehicles and, you know, that's going to be a big piece of due diligence.
got it. Guys, do you have any questions?
Yeah, Ray, going back to when the owners have to stay on, say they have a license or something, and they have to keep whatever that 1 to 19%, is there a premium that they're getting in that, in the equity ownership that they're holding on to just for staying on or just for using their license, or are they being compensated for that separately?
No preferred equity or anything like that. I again, this is only a few months old. But what I've seen is, on a 1%, um, it's they're not like I normally ask the question like, is the seller going to be compensated from like a salary perspective? Because that obviously impacts the cash flow, and most of them they have not. I have seen in some deals, where the seller is compensated for using the license, and it might be like $30,000 year one or something like that. And then, the buyer wants to get the license from there on out after 1 year, having, you can go take the test yourself. But the equity itself, which is just, it's just a 1% equity stake in the business, or really it's when it's a 5, 10, 15, 19, you're buying the business at a valuation, but you're only buying that percentage of the business. So it's essentially like seller rolling equity. So the idea is you're getting the valuation of your business of what you want, whatever it is, but you're going to retain this equity. We're going to grow it. We're going to sell it. You're going to get that, rest of the proceeds of the sale from a bigger pie, hopefully. And that's sort of the idea. So they're not actually, in many cases, paying the seller anything for doing that. It's almost like they're saying, this is actually going to benefit you because we're going to be able to, one, licensing, we're going to have to solve one way or the other. And then, two, if it's a more than a 1% stake, obviously a 1% stake is not going to really get them interested. But, that second bite of the apple is more of an incentive. That said, I've also seen it structured where they want the seller to remain an employee in the business. And so they're going to be working in the business and they're going to get a salary for that. It definitely impacts the valuation and the cash flow. And we got to look at it that way. But, that's a really cool situation for sellers that, like in the trades where, hey, I just don't want to run the business anymore. I like being in the field. I like working with the guys. I like managing my techs. But this business stuff, I don't want to do that anymore. Or maybe I had a stroke or a health issue where I can't be stressed anymore with the business. But I'm 45, so I need to work. I've seen that. And so you're going to pay that person as well, right? A salary plus bonus or whatever, to work in the business. And they'll obviously, you have to retain a percentage of equity to do that.
Yeah. Okay. Yeah, that's good. They're paid through the appreciation of their interest, basically, or you can hold them on and pay them salary for continuing to do work.
Yeah, you got options there. It's, again, it's new, so this is kind of like, we're kind of starting with a blank canvas here, and I think there's so many different creative ways to go about structuring deals more now than ever before, which is really cool.
What is the smallest amount of shares of an entity you can buy?
Are you trying to go below 1%?
No. Can you go you can go as many. No, like you can buy 30% of the business with SBA.
You can buy, yeah, you can buy 1% of the business now. It's just,
Okay. Oh
it's
wow.
not going to make, it's got to make sense, right? So
Sure,
anyone who
sure.
owns 20% or more guarantees.
Guarantee. Okay.
So,
Understood.
technically you can buy in, I'm going to buy in 30% into a business.
Got it.
Well, chances are there's someone who's also already there in the business that's now going to have to guarantee your loan,
Makes sense.
right? Unless everyone is dropping below 20.
20%. Okay. Cool. Well, I appreciate it, Ray. Thank you for taking the time today. We have to connect in person nearby for sure. We have a big group out here in about like almost like 80 people around here. So between
Really?
Palm Beach, yeah, Palm Beach and Broward County and Miami. So we have to do that.
Doing a meetup.
Yeah,
Yep. We got it.
for sure.
Yeah, that'd be
For
cool.
sure. For sure. Thank you guys. Have a great rest of your day. Appreciate it. Thank you.
Good luck. Thanks, guys.